Hello friends, Namaste and welcome all of you to my channel. Today I will be discussing about under the budget constraint or the capital rationing situation, how could we take the capital investment decisions and mainly based on your internal rate of return criteria, how could we draw your investment opportunities schedule part. Theoretically, when we say your capital investment criteria, like your net present value or internal rate of return, the projects having the positive NPV or internal rate of return higher than the cost of capital, in case of your independent project, we accept those projects. Similarly, when we have your projects are mutually exclusive, then we would be accepting the projects with the highest NPV and the highest IRR as compared to your cost of capital. Okay, but in practically we have to take decisions when we have a budget constraint normally, then we are not able to invest in all capital project. We would be accepting the project based on our available financial resources, I mean to say. Now important question is about that term is known as your capital rationing situation, and that is all about that would be your affecting our capital investment decision, or we say the capital expenditure decisions. In general, the firm may impose such a limit because of the two reasons. One is called, that is your lack of funds, because as we say the financial resources are always constant. Sometimes we may not have adequate financial resources or the funds. Next one is that the company may adopt the conservative investment policy. Then in that context, your company is not going to park your money more in the long-term investment, okay, or the capital project. Then next one is all about now let's discuss about what we are going to discuss today. That is all about based on your internal rate of return criteria. That is nothing is the rate of return at which net present value of the project will be the 0. Now when we say the net present value, which is the discounted technique, that is nothing, that is your present value of benefits minus present value of your cost. We say that your net present value. It is widely used in your project also. Now let's discuss about the one example that's very interesting. Why I'm saying this one, because we are going to illustrate your internal rate of returns in real life also. We could apply this concept. Like we have a project, we have A, B, C, D, E, F, and while the cost of capital is the 10%, with the fixed budget we have a 2,50,000. Okay friends, now look at your internal rate of return figure. That is called the minimum required rate of return that company needs to earn, okay, for sustaining the businesses. That is the 12%, your 20, 16, 8, 15 and 11. Mainly what we do, based on your cost of capital and this IRR, we would be ranking your investment in a different project, and we look after the highest IRR. Just for example, is all about your 20 is the first one. Now this is all about we try to rank it. In third column we just copy the same thing, okay. Then fourth is all about we are ranking this one, like if we have a cost of capital is 10%, look, the B project will provide you the highest internal rate of returns, okay. Even though you are investing just 70,000, but it will provide you the good return, that is your 20%. Similarly, in the C project, investment amount is 1 lakh, it will provide you 16%. Then we just rank is 2. Then third one is all about it provide the 60,000 in the E project, that's the 15, the based on which we rank it. Then is the fourth column we rank it. Fifth one is all about we look at your investment, respective investment amount, like in one we have one project, one is we just accumulate it, okay, you just accumulate it, like your ranking is 1, your based on ranking A is the B is the 70,000. Then second project is the what, this is the C, so B plus C is the 1,70,000. Then Next one is that this is way BC, like BCE, based on which we can find the cumulative investment. Now, important part is that based on this calculation, how could we draw the investment opportunities as schedule part? Now look at your total internal rate of return is all about your 20%. Now, because of that reasons, your y-axis is your internal rate of return, that is your 20%. This is, and the minimum rate of return is the cost of capital, which is noted by the K, and this curve is called like your IOS is your investment opportunity schedule, as I explained here. Now simply you draw your this cumulative figure, as I explained earlier. You draw this line, okay? Then this is the B, this is the C, this is the E, A, F, and even though your D project, which provides you the your return, which is lower than your cost of capital, you just draw the line similar to line chart. Now your budget is, we have a budget constraint is just 2,50,000, okay? Now look at the B, C, E. You cannot invest, you can't accept the A. Reason is that if you are accepting, it will take, we need the about the 3 lakh, we need 3,10,000, but we don't have that much fund. So we cannot accept the all project. So we would be investing in the project B, C, E. Reason is that we have a budget constraint, okay friends? Now when we draw this concept and we draw in our practical life also, we have to take your capital investment decisions, whether that is your, I'm talking about your company level, but even we could apply in your individual life also, because we have to take decisions based on our budget constraint. Okay, these are the content that I would like to share today. If you like this content, please like, subscribe, and share this channel. I will be sharing this content in my Facebook channel, and I will be also sharing in my Twitter also. You could follow and share this content also if you like. If you have any your comments, I'm requesting all of you, please provide your suggestion also, so that I could enrich my content, and I would sharing my understanding to you all. Thank you all of you for watching this video.